makes sense of this economy? Like I just mentioned in the intro, you had GDP, I think surprised a lot of folks out there, almost rise 4%. You got a labor market not breaking 100,000 non-farm payroll increases anymore. How do you see things as we stand here right now?
President Trump and Secretary Bessent, Brian, are certainly not surprised by the very strong near 4% growth in the second quarter, which was the president's first full quarter in office. The key thing about the labor market is we know now with revisions that the Biden economy was not particularly robust, roughly 1.5 million in downward revisions over the past year or so in light of what was first reported. So the handoff to this from one administration to the next shows a much weaker, fragile economy. The good news, of course, is that President Trump has passed the One Big Beautiful Bill with the help of Secretary Bessent. That will put a floor under growth, and we're seeing a big CapEx come back, a big surge in investment spending because of that bill, which is retroactive, Brian. So the forward on the outlook is excellent. And I like to highlight the fact that the widely followed Atlanta Fed GDP now, following last Friday's very strong consumer spending report, has growth up near 3.9% in the third quarter. So it looks to me like despite the weak labor market the prior administration gave us, top-down GDP looks great.
So the 22,000 increase for August, Joe, we might see, let's say, 45,000 economist estimates for the upcoming report. You think that is the floor? These are some of the lowest numbers we might see this year?
I don't know, Brian, if it's the floor, but I know last year, right before the election, the Fed cut 50 basis points when the trend in headline jobs at the time was 116,000. Now the headline trend in jobs is just 29,000. And that reflects, I think, President Trump's frustration that rates need to come down. Fortunately, the Fed has moved in that direction, and policymakers have highlighted that rates are likely to come down further. So if you have rates not a headwind to growth, then certainly you could see the labor market turn, because one of the risks, of course, is that interest-sensitive spending in areas such as housing are vulnerable. So we're hopeful this is a floor. But again, the good news is we've put in place tax regulatory policies. We've got low energy costs. All those factors should propel the economy much higher, not just in terms of the great GDP we're seeing, but also this labor market hopefully being a soft patch and growth accelerating sharply in 26.
3.8% GDP growth. Joe, should investors view that as the pace moving forward over the next couple quarters?
Certainly, Q3 looks like it's going to be up near 4%. 3% was the growth we had roughly in President Trump's first 3 years. Growth was just under 3. The third year growth was almost at 3.5%. So a 3% number does seem very reasonable to us. As Secretary Bessent said last fall, early winter, that 3% economy is very doable. And that matters, Brian, because a 3% economy is going to generate revenues and put this economy on a much more solid fiscal footing, having run historic, unprecedented deficits over the past 4 years in an environment with full employment.
So do you see, against that backdrop, the job market reaccelerating in early 2026? And what is that reacceleration? Yes. What would that even look like?
So we do expect the job market to reaccelerate, and the fact that jobless claims have moved back down is very encouraging. What we expect to see is the broadening out in hiring, financial and professional services, manufacturing employment accelerating a bit, construction employment accelerating a bit, retail, wholesale trade, transportation services. The whole shebang, if you will. We should see broad-based job growth as the economy is generating this fast growth. You're going to see multiple of industries higher. That's what we'd expect to see. That's what's in store. But again, the U.S. economy does need some help on the interest rate side, because the 3% plus growth is great right now, but we're not going to sustain that if monetary policy, by the Fed's own admission, is working to restrict economic activity. In other words, monetary policy interest rates cannot be a headwind to growth, because we won't meet our full potential and the labor market will not improve as much as we think is likely. 3%
GDP potential. You're talking here, Joe, about a reaccelerating job market. How many more rate cuts against that backdrop, which to me seems pretty good? How many more rate cuts do you think are necessary?
Well, neutral rates, the Fed has the neutral rate around 3%, and the funds rate right now is still above 4%. President Trump, of course, wants yields to fall significantly lower. I think we need to see what the data look like. I was listening earlier, there's been no tariff effect. I know the fact that we're still looking for it in the numbers suggests that even if it shows up at some point, the effect is going to be relatively de minimis. And that was one of the main reasons why the Fed has been slow and cutting rates, is they've been worried about a tariff effect, which simply has not shown up and is not going to lead to higher inflation expectations. So we'd expect rates to come down quite significantly. We'll leave it to the Fed to figure out where that level is. But again, all of their internal estimates suggest that rates are still much too high relative to where they are at the moment.
And Joe, there's still a contingent inside of the Federal Reserve that is really, they don't want to necessarily go out there and cut rates gangbusters. And I look at what Cleveland Fed President Beth Hammack said this morning, suggesting that inflation might be around to 2028. What do you think about some of her comments?
Well, the thing is, energy prices have come down quite significantly. We've seen food prices moderate. We know rents are coming down. Inflation is a lagging indicator. Since President Trump has been in office, we've seen virtually no increase of any meaningful increase at all in goods prices. We've seen the impact on the services side, but we do expect service prices to moderate. I mentioned housing. Housing affordability itself is at record lows. That's one of the reasons why we like to see interest rates come down and make it more affordable for people to buy homes. But we don't really see any inflation effect right there, where it's a worry. And the markets as well are not signaling there's any inflation effect. If you look at break-even inflation, five-year forward inflation expectations, none of those things, Brian, suggest there's any inflation problem whatsoever.
The Fed chair last week, Joe, had a lunch, made a few comments, and my interpretation was that he pushed back on the need to come out here and aggressively cut rates. Is the bottom line that we just need to see a change in who is leading the Federal Reserve to get the rate cuts that you want?
Well, the thing is, the Fed historically has been very slow in cutting rates, which is why the economy could look really good and all of a sudden it tips over. And that's the comment the president has made, but it's consistent in the academic literature. And that's why, when some people on the FOMC or one of the reserve banks, as you mentioned, President Hammack, you have a situation where inflation is telling you what the economy was like some time ago. You had very robust government spending under the prior administration. This administration is slowing government spending and trying to get rid of the waste and abuse, trying to create a more efficient system. That itself should free up resources and lower the inflation rate. So if you're looking at the inflation rate now, as Milton Friedman famously said, it's like driving your car looking in the rearview mirror. You need to look at forward-looking indicators, and those forward-looking indicators, and when you look at credit spreads, financial market expectations of inflation, all those things just do not suggest, Brian, there is an inflation problem. So we're hopeful the Fed will move in the direction of lower rates. They have cut. We expect them to cut again because they basically made that commitment. Historically, when the Fed does cut initially, they cut more. We'll see what happens.
From your seat inside of Treasury, Joe, will the administration signal to markets who is likely to get this job before year end?
Secretary Bessent has come up with we've got a list of 11 people, all highly qualified. The Secretary is working through those candidates. In due course, he will give those to the President. They'll be whittled down to some number. I don't know what that is. And then the President will make a decision. I can't say whether it's going to be in December or next year. That will depend. And as you know, there are potential other Fed governor positions open. So the administration will have to potentially fill those seats as well.
Always great to get some time with you, Joe Lavorgna. Don't be a stranger. We'll talk to you soon.
Yes, I was going to say the same. Thank you, Brian.
I appreciate it.